You turn on NPR radio, or maybe you overhear Dad's cable news show, and you might hear something like this. The Dow gained 132 points, closing out the hour at 34,896. And maybe you're like, thank you for that, but those numbers are actually completely meaningless to me. Like, you might as well be telling me how many times you farted last hour. That's how much that means to me. Hi, everyone. It's Amanda Holden, also known as Dumpster Doggy over on social media. And welcome to my new series called A Brief History of Getting That Bread, where we take a look at financial concepts through a historical lens so we can understand, well, first of all, what the fuck is going on, but importantly, how did we get here? And today we're going to be talking about the history of the index. And you can't talk about the history of the index without talking about the history of the Dow. Now, quickly, before I begin, I want to point out something that can feel a little bit confusing. You may be familiar with an index fund, which is something that you can invest in. And an index fund mirrors some index. And so today we're exploring this route. We're exploring the index itself. All right, so before we dive into the history, let's do a quick definition. So the Dick defines an index as a number or ratio derived from a series of observed facts. Remember this? It's just a measurement of average performance. That's it. So basically, an index is taking this big step back and doing a vibe check. And in this particular context, it's just a mathematical vibe check of the stock market. Another way to say it is, are the investments that we're trying to measure with this index, are they on the whole going up, or are they losing value, or are they just chilling? Fun fact, the plural of index is indices. Funner fact, if you ever encounter somebody that actually uses the word indices in a sentence, they've definitely never had a Four Loko. Unless they're me. In the United States, the two most popular stock market indices are the Dow Jones Industrial Average, that's a mouthful, and the S&P 500, which is not to be confused with the Daytona 500, although both probably make your least favorite uncle want to scream at the TV. The S&P 500 index is currently a more useful measure of the US stock market's performance overall because it includes more and better data, and we'll come back to that. But the Dow Jones Industrial Average was the first, so let's explore that history. Okay, so who, what, where, when, how is a Dow? Well, Dow is a guy. And the Dow Jones Industrial Average was named after its creators, Charles Dow and Edward Jones. Now you might be thinking, oh, I bet that Charles and Edward were like the original finance bros, right? Like, after all, every finance bro is named Chad, which is basically just the combination of Charles and Ed. Chad. Very Bennifer, if Ben and Jennifer were analysts at Morgan Stanley. But in actuality, Charles and Edward were nerdy journalists, and Ed was a statistician. And together they founded what would ultimately become the Wall Street Journal. Ever heard of it? Truly an enduring legacy to their beautiful bromance. But long before the Wall Street Journal was the behemoth that it is today, it used to just be Chuck, Eddie, and then some other guy whose name was probably too weird for the letterhead, doing some local journalism on the business and finance beat. You see, it's the late 1800s. It's a time in history where there's a lot of money being made, but there wasn't exactly a lot of accountability. A real high time for crooked salesmen, financial charlatans, and lying and cheating businesses.
Hello, my good man. Would you like to buy some stock in my steamboat company? It's been 0 days since our last accident.
So Charles, the journalist, was basically just like, y'all are just a bunch of rapscallions and I'm gonna keep an eye on you. And so he would literally walk around Wall Street, like the actual street Wall Street, every single day, asking everyone about the prices of the stocks that they were selling. And then he would scribble those prices into a daily newsletter for public consumption. He would do this along with information on the actual companies and their underlying financial health, like whether or not they were actually profitable, and therefore whether or not their stock was worth buying. And then our sexy little nerds would totally throw shade at any business that wouldn't disclose their financial information.
No, not price transparency.
And so our guys gained mad respect by doing this, and truthfully, the practice majorly transformed Wall Street for the better. But that's not all. That's also when they came up with this idea of providing not just information on individual stock prices, but providing a snapshot on how the overall stock market was doing. Now, at this time, railroad and transportation stocks were basically today's Amazon and Apple. Trains and transport had come a long way during the century. Some trains even offered passengers a luxury travel experience.
Hello, yes, I'll have the antelope steak and a lemon chiffon cake. And one of those cocaine sodas. I'll have two of the cocaine sodas.
And so, with the golden age of railroad in full swing, people were curious how transportation companies' stocks were performing. And so our boys had the idea to start publishing, again, not just the individual prices of each one, but the daily average of all train stocks. And they called it the Dow Jones Transportation Average, and it was the first ever stock market index. Okay, so their first index was measuring railroad stocks. Their second index was measuring industrial stocks. So things like sugar, electricity, tobacco, leather, and rubber companies. Side note, they used to reuse rubber condoms back then. Yeah, apparently it was a selling point. Now, granted, this was around the same time that they invented oscillating bathtubs and protective eyewear for chickens. I don't think that any of those things are related, but if they are, can somebody invite me to that party? Okay, so our guys took the daily average price of all of these industrial stocks and they named it, you guessed it, the Dow Jones Industrial Average. And we still use this same Dow today. Now, granted, only one of the original companies remains, that's General Electric, but the idea is still the same. It's still a measure of a handful of quintessential US company stocks, 30 to be exact. And so like I mentioned before, nowadays there are more useful measures of the US stock market, such as the S&P 500 index, which measures the 500 leading company stocks in the United States, so the biggest and the baddest. Or you can use something like the Russell 3000, which includes every US stock in its measurement. But that's not all. There is an index that measures the performance of just about any category of investments, from certain types of stocks, so technology stocks, to bonds, to housing prices. Although there's no index for oscillating bathtub stocks right now. Sadly, that market died out. And so again, an index is just a measure of some particular market. It is just a vibe check as measured by some third party. Next, fast forward to the 1970s. Enter the index fund, which was popularized by Jack Bogle, who also started Vanguard. And so at the time, Bogle was working in the world of investment management. And at this time, all investing was what we call active management. So back then, the whole name of the game was to try to beat the average performance of the US stock market, as was probably being measured by the S&P 500 index. And frankly, nobody was good at it. And so Jack was kind of looking around at all of his comrades and was like, it has come to my attention that all of y'all suck at your jobs, right? Like nobody is managing a mutual fund right now that can actually beat the S&P 500 index. And so what I'm going to do is I'm just going to make an investment fund that mirrors the index. And everybody was like, oh, like, good one, bro. Good luck with that. Like, oh yeah, bro, what's next? You're gonna tell me that cigarettes aren't a healthy breakfast option? And guess what? It was as successful as he had envisioned with his fund that mirrored this third-party index, that mirrored the S&P 500 index, outperforming most actively managed strategies. And so nowadays, low-cost, passive, and index investing is hugely popular because of that historical success. And so we can buy index funds, which are basically these big baskets of investments, like a big basket of stocks that are designed against some third-party index. So for example, an S&P 500 index fund holds all 500 of the company stocks that are being measured by the S&P 500 index. A Dow Jones index fund holds all 30 of the stocks that are being tracked, again, by the Dow Jones Industrial Average. The idea being that with this fund, you will achieve the market average of whatever market the index is measuring. And if you would like to know more about investing using index funds, come and take my invested development course. I would love to have you, and I would love to be your teacher. The Dow gained 132 points today, closing out at 34,896. Yes, the Dow has a mathematical base and it is largely arbitrary. And sometimes people who really want to sound like they're smart will talk about the Dow in terms of how many numbers it is up or points it is up or down from this arbitrary mathematical base, which is not helpful, especially when the alternative is to tell us the change in terms of a percentage. Like the stocks as measured by the Dow are up 1%, or the S&P 500 is down 3% overall. Or another alternative is to not treat the hourly price moves of the stock market as if they're news, because it's not news, right? These days, investment news is consumed like entertainment. And for many people, it is addictive. It's a cocaine soda, especially if you are taking a long-term view with your investments, which I encourage you to do. Then fixating on the daily, monthly, or even annual performance of the stock market, and therefore your investments, can be very counterproductive to your financial and spiritual and emotional health. Really, these indices are useful for observing longer-term patterns so we can determine whether we want to participate in these long-term patterns or not. I think of watching stock market performance as if I'm watching a 40-year-long baseball game. Would you really want hourly or even daily updates on a 40-year-long baseball game? No, absolutely not. Do not bother me with that shit, right? Like, unless it's an update about Bennifer, I won't be needing it hourly. Thank you, everybody. Thank you, everybody.